Good morning, this is Mark Boud of Real Estate Economics. Thank you for joining us for our Fresno, California webinar. This morning we'll present some market information and economic forecasts for the Fresno market, which we define as Fresno County. The adjacent counties, Kings, as well as Tulare and even Madera act somewhat similar to this, and so if you understand Fresno, chances are you'll understand some of those outlying counties in the Central Valley as well. To go into what the overall housing transaction picture looks like, this is what it looked like as of April 2011. Here we are in June, so this is the most recent information we have, and it shows that this market is still very, very heavily influenced and driven by distressed housing. Foreclosures, properties being lost to the bank, represent 23.3% of transactions. Foreclosure sales, the bank selling properties to a new owner, represent 34.6%. The fact that foreclosure sales are so much higher than foreclosures is a good sign, even though it's all distressed inventory. Well over 50% of the transactions is distressed. It is being sold faster than it is being created. So there's a net burn-off of overall distressed inventory. New home builder product is only 4% of the market. That's far lower than it has been. We'll show you in just a moment what a normal market looks like. And then the resale market is only 38%. Back in 2006, you can see what the overall transaction shares looked like, much more of a normal market atmosphere in terms of shares. New home builder product is representing almost 25% of overall transactions. Resales represent over 71%, and the balance, less than 4%, is represented by distressed inventory. That's more of a normal picture in terms of distress, or in terms of overall transactions. We're far from normal right now, and unfortunately this will continue for the next few years. In terms of what's going on, most recently, in price and price per square foot trends, we've actually lost ground during the past 12 months as we've dropped an average price from $179,802 back in April 2010 down to $161,543. We've also dropped about $10 in price per square foot. Those are significant shifts, and I hesitate to say that it is all depreciation. There has been some depreciation, but a lot of this is because the transactions are increasingly skewed by the sale of foreclosures by the banks. In other words, as the sale of foreclosures by the banks become a larger piece of the overall transactions pie, their reduced prices are going to skew the overall market more and more. So what I wanted to point out in this particular chart is that resales have actually gone up in terms of market share. That's a good sign. Foreclosure sales have gone up even more. That's also a good sign, though it tends to skew the overall price down as we clean up that distressed housing in the system. And foreclosures have actually come down, which is also a good sign. So the trends are positive, but the problem is it's going to take a long time to clean up the distressed housing inventory in this particular market, which is still enormous. In terms of mortgage amounts and loan to value is about 88%. It has been much higher back pre-financial crisis, as this market is mainly driven by FHA, VA loans. Now we're requiring larger down payments between 10 and 12%, as opposed to 4 to 5%, which tends to slow transactions. Here's where those transactions lie by price range. Most of the activity is occurring below $300,000 and even below $200,000 in the most current market atmosphere. And here is our picture of distressed housing. Notices of default, foreclosures, foreclosure sales. Now, notices of default are trending downward, which is a good sign. Foreclosures tend to lag notices of default by several months. And so the fact that they've come down dramatically from the peak in 2009 to 2010, and our forecast for 2011 is another fairly substantial drop, is a good sign. It means that foreclosures have to fall. We're already seeing that in the data. While foreclosures are falling, foreclosure sales are actually increasing. And you can see what the overall net impact of that is. If you take the cumulative impact of foreclosures relative to foreclosure sales over time, you see this big buildup of distressed inventory. Hit a peak in 2008. We sold off a lot of it in 2009, but 2010 was not a good year. We actually added to that distressed inventory. We think that based upon current patterns, we'll burn some of that off in 2011. We're already burning that off, but it still leaves a very high level of distressed housing that is held by the banks, and it will take years for that actually to come back to normalcy, even beyond 2016. Even though by 2014, 2015, 2016, they do not compete with the new home market nearly as much as they're competing with it now. It's still a problem all the way through 2016. We don't even hit a normal level. A normal level is 100 or less per year, and we don't think that we'll see that until after 2016. In terms of total housing supply, the construction patterns on an annual basis, you can see these all-time lows that we've hit since 2010. That continues through 2012 before we begin to see some uptick. But we really don't even hit a normal pattern of construction till about 2016, partly because of the problem of distressed inventory right now. If you add distressed inventory to this pattern of construction, this is what you get, where at the time we're burning off distressed inventory, we're also increasing construction, but it all leads to a net lowest level of construction plus distressed by 2014. In other words, overall housing competitive supply will probably continue to decline through 2014. That's good for those builders who were out there. They'll glean more market share, but they're still competing with a lot of distressed inventory, if not new housing demand. In terms of overall employment, you can see the drop that we've experienced as well as our 5-year forecast. For the next 12 months, we're actually forecasting fairly healthy job growth. We're already beginning to experience that, partly because of the types of jobs that are being created will be a little surprising. A lot of manufacturing jobs are being created. Part of that has to do with successful agricultural processing, an expansion of agricultural processing as the prices of agriculture has gone up a bit and exporting activity has increased significantly. We're also seeing small increases in trade, information, health and education, and leisure and hospitality. We're seeing losses in government. That'll continue. We're seeing fairly significant losses in professional and business services. That's anticipated to turn around this year. Construction will probably continue to lose throughout this year. But overall, this pattern of job change for the past 12 months, even though this is not the most healthy report, it's a lot better than what we experienced a year ago. Here we are between March of 2009 to March 2010. You can see these enormous losses that we experienced back then. It's getting better. Problem is it's not getting better fast enough. It will take us quite a while to fill the hole that we've dug. And this is a graphic of that hole that we've dug in terms of job losses. Over 25,000 jobs lost between the periods of 2008 to 2010. We'll gain in 2011. In fact, they'll actually be fairly healthy gains, and it will increase thereafter, especially as 2014, 2015, 2016. Some of that assumes the construction of the rapid transit line through the Central Valley. Now, that may not still occur. If it does not occur, this would have to be reduced, but that does tend to increase the economic activity in the Central Valley significantly due to that massive construction project. All of this translates to supply-demand patterns that look like this. Green is demand, blue is supply. The gaps between the two is either oversupply, here it's shown graphically, oversupply where we are right now, or undersupply. Right now we're coming off of a historic high in terms of oversupply. We're eating into that, but it won't be until about 2015 until things really tighten up. And thereafter, we think that we'll actually enter into a new period of undersupply, partly because we're building so little, and partly because we think that the economy will come back fairly strongly during the next 5 years. Now, there's another part of the model. That's the valuation side. The blue curve in this particular chart shows where median prices have been and where we think they're going during the next 5 years. The green curve is where we think they should be based upon mortgage rates and based upon household incomes. A few other factors in there, those are the main two. The gaps between the two either represent overvaluation, as it did from 2004 to 2009, or undervaluation, which it does right now. Here's the difference between those two curves. This enormous level of overvaluation, this huge bubble, collapsed in 2007, 8, and went into actual undervaluation as early as year 2009. Right now, we're near a record level of undervaluation in this particular market. This is lagging other markets where it's peaking right now in undervaluation. It's already peaked in most coastal markets. But what it means is, despite the fact that we have a lot of oversupply, we also have significant undervaluation. And unless you assume that oversupply is going to remain chronic, which I don't think it does, this is a cycle and eventually does correct itself, now is actually a very good time to buy in terms of undervaluation. Here are our forecasts for the next 5 years in terms of price appreciation. You can see the impact that it has on overall prices. Despite those fairly healthy forecasts, even by the end of year 2016, we've just surpassed the level that we had in 2004. So it's going to be quite some time before we hit those high water marks that we hit in 2006 and 7. Patterns in overbuilding and underbuilding in this particular market, as well as our 5-year forecast, relative to patterns in overvaluation and undervaluation. Overall, it creates our opportunity risk index, which suggests, given that this has a 24-month to 36-month lead, it suggests a weak to stabilizing market during year 2011 and a stable market in 2012. And based upon the strong index that we show for 2013, that actually leads to strong market conditions by about 2015 into 2016. That is it. If you would like to contact us regarding our consulting services, you can do so. Either contact myself, Mark Boud, or my associate John Mulville, or regarding any of our web-based information tools, feel free to contact either Judy Duell or Sandy Rivera regarding our subscription services. We'll give those who participate in our webinars a short complimentary dry run at our website to see how you like the tools. And hopefully you'll be interested in them and not only follow the webinars, but also implement the usage of our tools in your overall strategies. Thank you for joining us. We hope you'll join us in a couple weeks. Take care. Bye.